Nvidia and AMD are two growth stocks that are down huge. Let's take a look and see if they are undervalued yet and if one of them seems to be a better buy for the future than the other. I'm Austin Lieberman. I'm building a $1 million portfolio right here publicly on YouTube. Here's the value, currently at $52,666. We've put in $66,991, so we're down $14,000. And here are the stocks that I own just for transparency. Take a screenshot if you want to, but today we're talking about Nvidia and AMD. So let's take a look. We're using fast graphs right here. And this blue line represents the average price to earnings multiple, which is a way that stocks are valued over time for Nvidia. And the orange line represents a price to earnings multiple of 21, which is the growth rate of earnings over time. And so as we can see, it appears that Nvidia, this black line is the price as of yesterday. It appears it's in line with its average price to earnings multiple. So a lot of people might think it's a good buy. It has dropped a lot. It's dropped from $329 down to $165. That's like a 50% drop. If it grew back to its normalized or its average price to earnings ratio from now to January 31st, 2025, the return would be 57% for an annualized return of 18.8%. That beats the market average. On average, the S&P 500 returns between 8 and 10% per year. But we need to look with a little bit more detail to see if we really think Nvidia is undervalued. Because as you can see, the price to earnings multiple was very high after COVID. And so sometimes these popular stocks that everybody's talking about, maybe aren't as exciting as they seem. And so we've got to look a little bit deeper. So what I'm doing is I'm taking the period after COVID out because the price was kind of crazy. And I'm also taking the period before COVID out because Nvidia was such a smaller company back then that it's a different investment case than it is now. And we'll also take the great financial crisis out because that probably brought the price to earnings multiple down too far. And so if we look at this, I think it gives us a good idea of a price to earnings multiple that we could consider potentially for the future. And so we're looking at from 2010 to 2020, the average price to earnings ratio was 30.7. So let's remember that. The other thing we have to factor in was its average earnings growth rate because that impacts the way a stock is valued. It was 36% over this time. So remember, PE ratio of 30, earnings growth of 36%. So now let's take it back out to the full timeline because this shows us what analysts think the earnings are going to be over the next few years. These are analyst estimates. They're thinking earnings are going to grow 23%, 17%, and 20%. So that is slower than that 36% earnings growth rate, which means it should probably have a lower price to earnings multiple than it had when earnings were growing 36%. So if we go to forecasting and fast graphs, this is a good way to look at some potential valuations based on these forecasts. And if we know that the normalized price to earnings ratio has been, around 30, we could look at, I think, 30 as kind of the top of what we would expect the price to earnings ratio to be over time. And this is out to 2025. But I don't think it should be 30 if earnings are only expected to grow by 20% per year. So let's take it down to, say, 25. So if they hit these earnings estimates, which they could either beat them or miss, we'll talk about that in a minute, what they've done historically. And if it trades at a price to earnings multiple of 25, with earnings growing at about 20% per year, then the total return between now and January 2025 would be 20% for 7% annualized. So for me, that's not a super exciting opportunity considering how large Nvidia is at this point. They are in an industry where they're very reliant on things that are potentially outside of their control, like demand for things like semiconductors, the ability to get what they need, the supplies for data centers. Gaming can impact it. Cryptocurrency can impact their market. So there's a lot of things, as great as Nvidia is, that are outside of their control. And for me right now, I don't own it because I think it's just a little bit too expensive given some of the risks and given other opportunities, which are the stocks in my portfolio that I own. So that's my take. Last thing we'll look at here is how they've done against analyst expectations over time. And so this looks a little bit confusing, but red means they missed expectations, green means they beat, and yellow essentially means they were in line. So we can see since 2009, we've got 1, 2, 3, 4, 5, 6, 7, 8 beats for the years, and then 1, 2, 3 misses. So 8 beats to 3 misses and 3 in line. And so the reason we look at that is just to see those analyst expectations. How close have they been over time? And in general, Nvidia beats analyst expectations. So that's just something to consider when we look at those expectations. So let's jump to AMD. All right, AMD is a tough one to judge based off earnings history. So we've got to take this stuff out just because of how wacky some of this stuff was. And really, we need to use, we can look and see now that the blended price earnings ratio is 25. So it's lower than Nvidia. But if we want to look historically, we got to use something like price to sales just because their earnings history isn't as correlated, or you could say it was just way more volatile because of how the company was impacted over time. So for the future and right now, we can look at the current PE ratio of 25, which if you remember is lower than Nvidia. And it's expected, they're expected to grow earnings at 20-ish% over the next 3 years. So about the same rate. But if we remember, we looked at Nvidia and we brought it out to a PE ratio of around 20, I think, and it was like a 8 or 7% return annualized. AMD right here is actually showing, if they hit these numbers and they trade at a price to earnings multiple of 20 in 12/31/2024, their rate of return would be 34%, the annual rate of return, the total return, and then the annual rate of return would be 12%. That's actually a much better return scenario than what Nvidia is showing. And we'll just quickly look back and we'll look at it on a price to sales basis just because it'll be a little bit more indicative of the history compared to how the company itself is being valued today. So again, we've got to kind of take out this period where sales growth was negative per share and it just makes everything wacky. And really, the thing that we need to learn about AMD through its history is just how volatile it's been. And they were really struggling with the business model. But they've appeared to turn it around and get a lot more consistent moving forward. But that's not a lot of years of successful execution. And so that's just something to be aware of when you compare it to other companies that have a longer track record of successful execution. What if periods like this happen again? Which it seems like they've kind of turned things around, so I don't know if I would expect that. But to get a good idea of how it's been valued in the past and how it might be valued in the future, we've got to take out that craziness in the past because it just doesn't give us a good framework. And this is hard because post-COVID has been crazy too, so it's hard to get an idea of the future. But if we just use this, it shows the average sales growth rate has been 18% per year, and the normalized price to sales ratio, which is just another metric to value stocks, has been 5.10. So if we look at it based on sales growth and the forecast, we see that sales growth is about forecast to grow in line, but the current blended price sales ratio is 5.6, and so that's actually kind of right in line with where it's been valued recently. And so I think if they're growing 18% per year, it's not ridiculous to run it at a 5.6 price to sales multiple. So even if we use price to sales, you're still looking at a total return of 48% and an annualized return of 16%. If we take it down to a price sales ratio of 3, which isn't crazy historically, it's happened before for AMD, but I think it's a more solid company now than before. So I think this is kind of a less likely scenario, but who knows? Then you're looking at a negative 17% return for minus 7% per year through 2024. And so that's how those stack up. That's how AMD stacks up, and that's how Nvidia stacks up. In my opinion, right now, it looks like AMD is actually the better potential investment opportunity. But as I said before, I don't own either. I own these growth stocks, which are less profitable on a PE basis, but have, in my opinion, longer trajectories of growth, and most of them are more software based, so less reliant on supply chain issues potentially. And I just like the longer term growth opportunities for the companies I own, but I could be wrong. Hope you enjoyed this video. If you did, give it a like, subscribe to the channel so you never miss an update, and leave me a comment of what companies you want me to review.